10-year yields get to their lowest since December of 2017, breaking below 2.5%, something we didn't think we'd see, at least not ahead of Brexit, not ahead of some economic downturn, not ahead of some catalyst event. And lo and behold, we get it. This week, the Fed came out after the March FOMC meeting to tell us that there is going to be a pause, maybe longer than expected, and they're probably not going to be looking to raise rates. They will be patient, waiting for the economy to kind of show us what it's got. Likewise, I think that the market has been pricing in the possibility of a rate cut before the next rate hike. I think the Fed is on board with that now, and we saw a shift in the market, not only in yields, but in equities. We saw it in the dollar. It's kind of been a whoops kind of moment for the Fed, because the things are supposed to be very good here. The economy is getting better. We're supposed to be seeing rates go higher. We're supposed to see markets prosper, and all of a sudden things do a 180, and they did a 180 very quickly. So as we saw 10-year note yields, have been trading between 260 and 270, 265 and maybe just above 270. We're now down. We got very close to 240. Now, if you look at your Fed line, you'll see the effective funds rate is 240. So we have now 2-year, 3-year, 5-year, 7-year, and almost 10-year note yields all below the overnight lending rate. So that has to be something that is very concerning for the Fed, how flat the yield curve is, and just, in all those denominations. 30 years, obviously not quite there. But I think that the ultimate concern here is that everything's trading below the effective. That is basically a warning sign that a rate cut is coming. Now, the Fed has not said that yet, but if you look at the yields and you look at the curve, it kind of tells you that probably is going to happen sooner than later. I don't think the Fed is ready to cut rates yet, but the market may be a little bit ahead of it, ahead of the curve here, no pun intended. And if you look at market volatility, market volatility has been trending lower all year. But today we settled above the 14-day moving average for the first time since January. So it's been a big shift, not only once we got outside the range, and I think it didn't take the trade below to make a new low, but to get below 2.5% yield, that is really what sparked the buying and sparked the volatility, the desire, the insurance, whatever you want to call it, to get long, and that flight to quality bid took off. So right now, volatility is elevated. Now, it's not spiking tremendously to levels that we've never seen before, but to be above the 14-day moving average is significant. Now, the outright level isn't, but I think that volatility will suggest if we continue to extend these buying and yields go lower, that we will continue to see volatility go higher, because at this point it becomes a free fall. At this point, a lot of uncertainty in the moment. It's not more what you're afraid of happening, it's what you're afraid of what's happening right now. And I think that's what the market's telling you. And you're seeing that also in equities, which have really seen a major sell-off heading into the weekend. And that is to be concerning as yields are going lower. We're seeing that shift of assets from equities into bonds likely, but certainly a concern that flight to quality bid continues. And what do we have next week? Well, the post-Fed fallout. How low can yields go? How flat can the yield curve get? Those are two things we'll probably be looking at. I do expect a little bit of a reprieve, a little bit of a bounce back, yields to kind of creep higher, maybe get back to 2.5%. Look for the yield curves to maybe steepen out modestly, I think, at this point, because it doesn't make sense for this to keep happening. I think the point of capitulation has happened. Now we're going to wait and see where the dust settles. Likewise, the Brexit, which was supposed to happen next Friday, will not happen next Friday. They've kind of kicked that down to April. But I think at this point, it's very uncertain as to where they're going to land. That will continue to be a wet rag over the market and kind of bring down any kind of upbeat news. And lastly, there is a central bank meeting in Frankfurt being hosted by the ECB. Yes, we'll have some of our Fed representatives there, but I think the market has been over central banked in recent weeks. But we're going to hear from them again about the market, about the global economy and whatnot. Maybe they're going to try and talk up the markets, talk up the equity markets, and talk up yields, something they were unable to do or didn't do this week to maybe stop the bleeding. I don't think that'll have much of an effect. Even if the Fed says, yes, we think growth is coming and yes, rates are going higher, they've already let the cat out of the bag that rates are not going higher. And likewise, Europe has already let the cat out of the bag that they are going to continue to add to their quantitative easing. So I think at this point right now, they can only harm the market. So stand back and wait and see what happens. We have some longer-term auctions, not next week, but the first week of April, at the beginning of April, and that will be key to see demand for the auctions at these higher prices and lower yields. Because right now it seems to me that there is going to be a sustained demand for treasuries right now, and it's not a want to buy, it is a have to buy, and that will drive yields lower. But I think we're going to see a little bit of a reprieve, like I said, next week until we get some more data, until we get some more clarity. And likewise, I think this whole Brexit deal certainly we see the dust settle there before we can make any real macro decisions. But as we head into the weekend, yields are low and likely heading lower in the weeks and months ahead.